money managers becoming more circumspect about investing in EM economies while funds are being diverted to developed markets. Do you expect this to continue after the September's Fed meeting?
Maybe a first comment on tapering. We, unlike consensus, expect it to happen later, only in December, because we do believe that the Fed will want to gauge the effect of debt ceiling negotiations coming up this fall before they really decide what they're going to do. But be that as it may, tapering will come. And that means that costs of capital are rising, but markets have anticipated that to some degree, so treasury yields are already quite a bit higher, and we believe they're already where they should be even over the next 12 months. That notwithstanding, capital costs are rising around the world in EM, so that still provides a couple of challenges also for the EM world. So all told, I would not expect money managers to immediately move back into EM after the announcing of tapering.
If we do see QE being withdrawn in the September meeting, how is the dollar going to fare against EM and other currencies?
A withdrawal of tapering in itself, should be supportive of the dollar. And again, here financial markets have already responded, especially swiftly, of course, in emerging markets. So we've seen that effect. We have seen it only to a very limited extent on developed markets. So here we believe over the next 6 months, also the US dollar will strengthen over several of the DM currencies as well.
What is the likely impact on the metals markets, and how would you advise investors?
In metals, so let's talk about industrial metals, first of all, base metals. We had two drivers in the past. One was certainly loose monetary policy, and the other one was hunger for these metals out of China. Both have started to fade now, so not significant drivers anymore. But then again, on the downside, we see at least many of the base metals already trading at close to production cost. So we believe they're going to trend sideways. Gold is a bit of a different matter here. They're mostly driven by the monetary policies, and with that coming to an end, gold, we actually have a more negative assessment. We think the dollar price can go lower from here.
China's August PMI data showed factory activity expanded for the first time in 4 months. How are you approaching this number, because the trend is still quite dismal?
It's true that the macroeconomic data looked more encouraging recently, and it also leads us to believe that for the current quarter we're going to see a 7.5% growth number. However, if we dig a bit deeper into the trends, what we notice is it's mostly driven by exports and also investment, and less by consumption, or consumption really has slightly disappointed. So quote unquote, you could say it reflects more the old growth model of China rather than the new one. And on top of it, especially in the non-banking financing sector, we'll see further curbing measures. So taking this all into account, we believe nonetheless that the fourth quarter is bound to be a bit slower, probably just about 7%.
You've downgraded India to neutral recently. The first quarter data showed GDP grew by 4.4%, which is the lowest in the last 4 years. Are we going to see more pain?
Yeah, the situation changed fairly dramatically over the last couple of weeks. So the focus has now changed on repairing the current account deficit, and that by nature, in any country in the world, if you try to repair it, that leads to several quarters, sometimes even 1 or 2 years of subpar, subtrend growth. And we must also now assume that for India. So we expect, for example, for the fiscal year 2014, that we're going to stay below the 5% growth level throughout.